They're running out of money. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, Best Buy just issued a dire warning. I'll show you the problem plaguing Best Buy and other retailers and why rate cuts won't fix it. Plus, U.S. manufacturers are sounding the alarm. I'll show you why this isn't the news workers wanted to hear. But before we get to that, I want to follow up on a story from Tuesday where it suggested that Nvidia could send stocks crashing after the closing bell, and sure enough, they did. Let's head over to Bloomberg where he picked today's story up and the reaction from foreign investors as Nvidia tumbles after disappointing forecasts and Blackwell chip snags. But here's the big part. Fears of delays contributed to a stock decline of almost 5% after 7:30 a.m. in New York. But there was something else that happened. The shares had more than doubled this year through Wednesday's close, following a gain of 239% in 2023. But we noted, as expected, U.S. equity futures dropped along with Nvidia right after they released earnings. But what happened in overnight trading is foreign investors flooded into U.S. tech companies as many investors believe in the safety of U.S. mega tech companies. And this is important because right now, as the global economy heads into a recession, there's one thing people believe is immune, and that is U.S. stocks. It was up against lofty and unsustainable expectations, as according to Bloomberg intelligence analysts, that being an understatement after a 239% rally. Though Metre and others have increased their capital expenditure budgets this earnings season, there's been concern that the amount of infrastructure being put in place exceeds current requirements. That could lead to a bubble, but Nvidia CEO has maintained this is only beginning of a new era for technology and the economy, and this is a growing concern because right now companies are investing big money in overpriced chatbots that really do nothing, and everybody is wondering, when's this going to actually turn around and generate revenue and profits? What this is likely to cause is a massive bubble. We've seen this in the past. It's likely to happen again. And right now, not even consumers are behind the AI bandwagon. As we turn to Best Buy, as they lift their profit outlook in sign of improving demand, but that's only part of the story. Talk about improving outlook. I have some huge news for you. Now, many people have said, Steve, when are you going to run a backtest on your reports? Well, we started that. I had my programmer create a custom backtest engine. We have just run it on CTA Timer Pro. I had the results as of yesterday. They are impressive. We're going to be patching that up so we can put it out to our subscribers so they can just see how much we give them the edge. But let's talk about what's going on because you want to get in on this. When you see how good this report is based on the back test, you're going to want to get in before I'm forced to raise prices. Let's take a look. We have 21 open trades right now in CTA Timer Pro. They're all up. That's 100% win rate. We closed out 5 trades. We got stopped out for a total 8.3% gain across all 5 of them. Momentum Timer Pro, 8 open trades, 7 are up. That's 88% win rate. Closed out 5 trades yesterday for 3.72% total. That is all duplicatable, my friends. And we're going to run the back test next on Momentum Timer Pro. Got to retool the engine for that, but we're going to give you all the edge you need. Now, how do we do that? We take a look at machine positioning every day across the broad equity, bond, and commodity markets, as well as the momentum. But first with CTA Timer Pro. When machines get deep short and they move against them, we flagged it on our report, but now we know what the probability of success is. But maybe you like to trade momentum. Well, that's simple, but we do it in a better way. We take all those technical signals, run a proprietary overlay, but we look at momentum over a 1, 3, and 6 month period and then look for a shift in it. And soon enough, we're going to have a back test on it. We're going to have the edge. You want to increase your probability of making money in the markets or as an investor on a long-term plays? We've got the answer for you. You got the daily reports. You get the tradable signals. I give you my opinion. You want to know why we have such a strong win rate? I review every trade. I give you the stop loss levels so you can duplicate them. We track them, the good ones and the bad ones. We give you an update on the stop loss levels every Saturday. 100% duplicatable. 30-day free trial, and soon you'll have all the information to make high value trades. When you see the probability table for our success rate, it will blow your mind. Links in the description below. Jump on that before it's gone. As Best Buy has been trying to reverse its streak of negative sales, this is a problem because we talk about the issue with Best Buy and other retailers. It's consumers are running out of money. You talk about what happened now. Everybody bought into this narrative that we're going to see this soft landing or no landing scenario. So what did you see retailers do? Well, they built up inventory. Wholesalers built up inventory. Manufacturers built up inventory because everybody believed if you build it, that means the customers are going to come. Well, it turns out they're not because they're broke. As customers have stayed on the sidelines after buying laptops and other electronics during the pandemic, which makes perfect sense because they had the money to. Inflation and interest rates have hurt discretionary spending as shoppers prioritize necessities. Higher ticket categories like appliances have been especially squeezed, but the reality is it's not inflation or interest rates that's the problem. Because if that was as simple as that, we wouldn't be seeing these issues. The reality is wages are not keeping up with inflation. That's the problem here. It's not a function of interest rates. It's a function that people need to make more money, and we have the data to prove it. Because when we look at total compensation growth, this shown in red in form of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, we're going to look at this against the consumer price index because you see a nice relationship here. When consumer prices go down, you tend to notice it either leads or follows a decline in average hourly earnings. In this case, it makes perfect sense. As manufacturers have less money to dole out because growth is slowing, well, that means it falls back to their employees. But when there's cases where you see here in the 1990s recession, where total compensation growth is slowing because there isn't the demand, because there isn't the paycheck to afford the discretionary side of the economy, you get inflation coming down. And you see this relationship over and over. This time, the data suggests that consumers are ahead. The red line is on top of the blue line. Of course, we know this doesn't factor everything. It doesn't take in debt service costs. It doesn't take in all the recent increases in insurance, and certainly doesn't change into effect all the rapid fluctuations in energy prices that cause consumers to spend less. This is exactly what's happening in the economy, which is why we're saying consumers are running out of money. But it's not just Best Buy. Check this out. During the last earnings season, retailers have described a U.S. consumer who is prioritizing essentials but is increasingly buying new trendy products at the right price. And that's a key point, at the right price. They're willing to spend some money when they have it, but only if prices are where it's affordable. Americans are still on the sidelines for larger purchases and projects, partly as they wait for interest rates to drop. But that's not the case at all. I'm going to show you why interest rates don't matter in this case, not a bit, as such spending habits are benefiting retailers selling necessities and lower price discretionary products and hurting companies offering more pricey items, indicating that the middle and upper class are struggling as well. But there's this big notion that if the Fed just cuts rates and if interest rates just come down, it's going to unleash a massive amount of spending. But the data doesn't suggest that at all. In fact, what it suggests is things are going to get worse. Here we'll take a look at advanced retail sales as shown in blue. That's shown on a year-over-year rate of change against the federal funds rate in red. And you would think that if there is a decline in the funds rate as shown here going into the dot-com bubble, well, that should translate into a massive boost in spending in retail, but it doesn't. You'll notice it continues to decelerate as the Fed cuts. It happens again going into the global financial crisis. In fact, the only time we really see it is right before the pandemic. Fed cuts rates. We do see an increase in retail sales, but then the pandemic hit, so we really don't know exactly what happened. But this time, everybody believes if the Fed cuts rates, that consumers are going to go borrow and spend in a big way. That's not likely, because when the Fed cuts rate, it means financial conditions are tightening. We talked about the show the other day, how we're seeing delinquency rates rise. We're seeing financial conditions tighten. This isn't the recipe for increasing retail sales. The problem is retailers, wholesalers, and manufacturers are sitting on inventory, and it's only getting worse that they can't move. And Best Buy executives said they expect consumers to upgrade or replace their technology products over the next few years. That is, if they can afford it. Slower innovation has hampered shoppers' appetite, but they anticipate new products such as artificial intelligence computers and Apple's new iPads to help boost spending. That is, until they realize that consumers already know that these fancy, expensive chat boxes do nothing. That's the problem. They're trying to be sold this new technology, but no one can figure out if it's really worth it. But turning to Dollar General, talking about a company who's focused on consumers who don't have much money, look at this. Further evidence that even the lower class is going broke as they see plunging as core customers now feel the budget crunch. And this is dangerous because it just flows uphill. As you see people on the bottom of the social economic class run out of money, it flows to the middle class, the upper class, and we're seeing that evidence. Remember, we've talked about how wealthy people are trading down to Walmart. It's just a sign that the economy is drying up. And comparable sales will rise 1 to 1.6% for the year. Keep in mind, inflation's running at 3. So again, inflation adjusted, they're running at a negative here. Not a good sign. Dollar General cut its profit view for the year. And so you think about, of course, Best Buy, who believes that they're going to turn things around. The reality is they're not, because the economy is just drying up. There just isn't the money to support it. They operated more than 20,000 stores. Dollar General is working to improve performance under the CEO who returned to the company last year, and he's vowed to boost the results. Check this out. By focusing on labor hours, and that's a key point. So they're in trouble, and I mentioned this. When demand goes down, what you're going to see is retailers do is cut hours. They're going to cut employees. They're going to try to maximize the best employees they have. And when you put people on the unemployment line, or you reduce their income, that causes a knock-on effect, a downward spiral. As they have less money to spend, well, it backfeeds into other places where they normally put money, and next thing you know, more hours are getting cut, more jobs are getting lost. It just continues to head down. But they're also focusing on value products and the supply chain, because that's all that people can afford. So they're trying to cut their expenses every possible way, and they're also simplifying operations by removing items and slowing new store openings, focusing on what customers want to buy, and that makes a lot of sense. Because when we talk about, cutting prices and labor hours, this makes sense because we look at unit labor costs for all workers. This shown in blue against the consumer price index in red, and they're both shown on a year-over-year rate of change. And if you want to know what really is driving inflation here, well, it's wages, and you can see the blue line is leading the consumer price index. So while many people believe that inflation is going to rear its ugly head, the Fed is changing its opinion, and for good reason. You can see on this chart, when you see, of course, unit labor costs continue to head down, especially here in modern times, there's no chance inflation is going to turn around until consumers have the money to go out and spend. That's not what we're seeing in the near-term future at all. During the earnings season, retailers, just like Best Buy, have said U.S. consumers are prioritizing essentials and buying new trendy products only when they're affordable. But look at this. Amid high inflation and interest rates, they're selective and remain on the sidelines for larger purchases and products. It's very simple. They can't afford them. That's the bottom line. And retailers just don't believe it. They think, well, if there's a couple rate cuts, the next thing you know, people can afford it. As you've seen, the rate cuts aren't going to make any difference. And lower income consumers, dollar stores' core customers, have pulled back spending and are feeling more strained than other groups, which makes perfect sense because inflation impacts them in a much bigger way. And other retailers like Walmart and Aldi have ramped up competition with low prices and deals. So now all of a sudden, when people believe we're going to see inflation, what you're seeing now is retailers fighting for what dollars consumers do have by cutting prices, cutting expenses, doing everything they can to drive traffic in the door, hoping while they're there, they'll spend some money on something else. But what we're finding out, they're not doing that either. And comparable sales for Dollar General rose 0.5% for the quarter as earnings came in below estimates. But look at this. While the company is working to offer value, financial pressure on customers is hurting revenue. Sales of seasonal home and apparel fell in the quarter, although traffic rose. So they have people coming in the door more often. But look at this. Shoppers spent less per trip. So what does that translate to? People are looking for a deal, and they're not looking to spend money on things they don't need. They're only looking to buy when they need it. So they're willing to go buy the store more often, hoping when they have money to find the deal they're looking for. If they're not finding it, they're leaving and coming back another day. You can see this is a huge change in spending habits because the company now is relying more on promotions, and that's hurting profit, again, at a time when people believe, as we started the show out with Nvidia, that safety is in the U.S. equity market. While we're hearing from retailers, there's not going to be any safety here at all. Because when we look at corporate profits against inflation, many people believe, and this is why they're buying stocks, is that when inflation comes down, you see corporate profits shown in blue on a year-on-year rate of change goes up. And we go back to the early 90s, we see that relationship. We can see that here going into the dot-com bubble. You notice inflation comes down, and what happens? Corporate profits go up. But as we move into more modern times, you see they get into sync with each other, suggesting that as demand goes down, earnings are going to go down, profits are going to go down, and that means stocks likely to go down as well. But let's talk about what's going on with U.S. manufacturers. This risk to the U.S. jobs market is now starting to emerge in the regional Fed surveys. And this is, again, not the news that workers want to hear, because they need to find a job. Those are at least on unemployment. And those who have a job would love to change so they can get higher wages. But right now, it's not looking good. As August indices in each of the 5 recently released regional manufacturing reports show shrinking payrolls at factories and gauges of employment at service providers are settling back. Measures of hours worked are also slipping. So we heard this from Dollar General. Now we're hearing this in the manufacturing sector, that they're cutting hours. So as more hours get cut across the board, it's just less money that's going to get spent in the economy, leading to more hours that are going to get cut, less money, and eventually more people hitting the unemployment line as demand continues to fall. And factory workers are also experiencing a broad decline in hours worked based on the regional surveys, as in New York, manufacturing hours shrank the most in more than a year. Indices for Texas and the regions covered by the Philly and Kansas City also show extended periods of declining work week. And here's a big one, raising the risk that job cuts may follow. It's not a question of if, it's a question of when, because you cut hours enough and then people start complaining to their boss, I'm not getting enough hours. So next thing you know, they start cutting some jobs to give the employees they want to keep more hours, and next thing you know, those people hitting the employment line, well, as we're about to find out, there's no opportunity for them to get back in the labor market. As initial jobless claims drop again, as the labor market sends mixed signals, well, the only signal it's sending is things are not getting better. Let's take a look at the unemployment data. The initial claims are at 231,000, so remaining fairly steady here in the low 200,000 level. But look at continued claims. It rose slightly by 13,000 to 1.868 million. So what this is telling us is about everybody that gets an initial claim that heads to the unemployment line, there's an equal number that are coming off continued claims, and that's a good sign that at least we're at an equilibrium here. The problem is, if it doesn't change, if we don't see continued claims come down here and soon, what it means is initial claims are going to head higher. Let's take a look at this chart here, because we've got continued claims in blue against initial claims in red, and you can see where continued claims go, initial claims follow. So while initial claims do remain low, the question is this gap going to be filled? The answer is yes. It's going to happen one of two ways. Either initial claims are going to rise or continued claims are going to fall. But based on what we're hearing from Best Buy and Dollar General and the regional Fed manufacturing surveys, is demand is going away. Hours worked are getting cut. And that doesn't mean we're going to see a resurgence in the labor market. What it means, we're about to see a lot more Americans hit the unemployment line, and that's telling us we're headed squarely to a recession. And in that case, don't look for the U.S. mega tech companies to save us. Look for them to come crashing down as well. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.